Hey guys, it's Scott Horne with the Owner Finance Network, and in this video we're going to take a minute and we're just going to talk about seller carryback loans when we're trying to negotiate a transaction and buy a property. So if you like the video, take a minute and like it, guys. Don't forget to subscribe to our YouTube channel. If you got any comments, guys, comment below. We'll do our best to get to those for you. So seller carrybacks, whenever we're negotiating transactions, a lot of times you come across transactions that may have substantial equity in it in some format. And of course, the seller doesn't want you just to come in, buy their home subject to the existing debt and leave all their equity on the table. So when you run into that, there's only a couple of options in how to handle that. Option one is you pay cash for that equity difference in some format. Option number two is you borrow that money from a private lender, creating a second lien on the property. And oftentimes those private lender mortgages are just going to be a little bit more expensive and maybe shorter term than what a seller may be willing to carry back. Then your third option is to work with the seller on a second lien mortgage, and that's what we call the seller carryback loan. And the fun part about this is you can structure that any way you want to. Now, oftentimes when I'm talking about buying homes subject to, as we go out to negotiate that deal, we can buy the home subject to the first lien. We may be paying the seller some cash for moving, various things of that nature, or part of their equity. And then we may put a second lien on the property as discussed, either with a private lender or the seller carryback. Now, when we're talking to that seller about the seller carryback, keep in mind that they're going to be secured by a note and a deed of trust, and it's going to be recorded in deed records in the county where that house is located, and that is their protection mechanism. They are in a position with their own asset securing that note and deed of trust. So if there's ever an issue about the collateral, whatever it might be, the seller already knows exactly what that is because it's the house they're selling, usually the house they've been living in. So there's a comfort zone there for the seller. Now from there, the fun part is negotiating that second lien with the seller, because there's so many ways of doing this. You can structure it with an interest rate. You can structure it with no interest. It can be a principal-only loan. One of the things you see a lot of in the marketplace is of course, that if the seller wants their price, we get our terms, and sometimes vice versa based on how you're going to negotiate that deal with the seller. I love the principal-only loans. In fact, I did one not too long ago where I bought the property subject to the debt and did a $95,000 principal-only second lien on the property for a substantial part of the equity. Now, if you're good at math, which you need to be in this business, look at the difference between an amortization schedule and what you would pay if you had put an interest rate in there versus a principal-only loan. Man, that equity goes down very fast with a principal-only loan versus that amortized loan. You can set up these loans for any term you want. You can put a balloon payment in there, 1 year, 3 year, 5 years, longer. It can be a full-term loan, whether it's 5-year term, 10-year term, 15-year term. Now, most sellers, as you'll find, they don't want really long-term deals. Some might, and can be negotiated that way along the way, but a lot are going to want usually a shorter term type mortgage out there. So as you walk through this negotiation process, the key is you need to know what is your property worth, what are the repairs, so you can look at that from an overall perspective. Of course, you need to know what that first lien mortgage is, the terms, conditions. And then as you look at all that in your purchase price and negotiations with the seller, what is going to work best and what is going to convince that seller to sell you their property? I mean, is there a hot button, more cash in their pocket? Is it less cash in their pocket and monthly payments? Maybe a little bit of both. And that's kind of the fun part, again, of buying houses, is getting a chance to negotiate this deal with the seller. I call it the art of the deal. Again, it's putting the deal together, the structure, it's getting that deal done and making it work so that you're able to take care of the seller's needs, but yet get the deal you want as the investor buying that house. Now, of course, once you do this, keep in mind you are going to have both your first lien subject to mortgage and that second lien on the property out there. So based on what your back end strategy is, just make sure you maintain those on payments basis. If you elect to do a wraparound mortgage on the back end as opposed to some type of rental scenario or maybe living in the home, we just have to make certain that we recite both the first and second lien mortgages in that paperwork so it's handled properly and correctly. So guys, I hope you liked this video a little bit, help you understand seller carryback loans. It's kind of wide open in how you can approach these scenarios a little bit. They work great. And, you know, I'm going to take one more leap out there and go, sometimes when buying a deal like this, you're not buying it subject to, but maybe you're buying it with a new mortgage. Maybe you're getting a DSCR loan. Maybe you're getting a mortgage loan. Maybe you're getting a loan from your bank. And of course, in the investment world, you're looking at 20, 25%, sometimes as high as 30% down payments. And you may not have all that, but the seller might be willing to carry back that debt on your behalf again. Now, if you're working with that third party lender, bank, DSCR, mortgage company, whatever, remember, they're probably going to want to know this. It needs to be part of your contract. You can't hide this from them in some format. We call it sourcing the down payment, whether that's cash or whether that is the seller carryback portion. And what they're going to be looking at, of course, is your debt to income ratio with that additional monthly payment added on there. So know what it is your lender is asking for. Of course, that back end deal is structured the same as if you're buying the house subject to. But just think through that deal a little bit, make sure it works, make sure your lender is aware of what you're trying to do, and get their approval up front. The last thing you want to do is hide that from your lender and potentially create some type of mortgage fraud. So let's avoid that like the plague, guys. So I hope you found it helpful, y'all. If you did, take a minute and like the video. Don't forget to join our YouTube channel, make any comments you got below, and we'll see y'all next time.